Good day, and welcome to Market Meridian. Today, we conduct a comprehensive analysis of a critical topic dominating financial discourse, Charlie Munger's renowned 6 warning signs of an impending economic meltdown, and their direct applicability to the AI-driven market environment we currently navigate. For those monitoring global financial markets, the current narrative is characterized by extraordinary volatility and speculative enthusiasm. The S&P 500 hovers near all-time highs, technology stocks have surged on the back of artificial intelligence, AI hype, and a prevalent sentiment suggests that this time is different. However, if there is one investor whose nearly century-long career spanned every major market crash, from the Great Depression to the 2008 financial crisis, and who consistently rejected the fallacy of this time is different, it is Charlie Munger. As Warren Buffett's long-standing collaborator at Berkshire Hathaway, Munger dedicated his career to warning investors of the perils of speculative manias, irrational exuberance, and the fatal errors that erode ordinary individuals' wealth in the lead-up to a market collapse. In this analysis, we will dissect each of Munger's 6 critical red flags, evaluate their relevance to the current AI bubble, and provide actionable, evidence-based strategies to safeguard wealth, optimize portfolio performance, and avoid becoming a casualty of speculative excess. This discussion is grounded in empirical, not theoretical conjecture. We will compare the 2000 dot-com bubble, Munger's most notable case study, to today's AI mania, examine why that AI is different argument constitutes a dangerous trap, and outline step-by-step measures applicable to all investors, regardless of experience level or portfolio size. Let us begin. At first, who was Charlie Munger, and why do his warnings matter today? Before delving into the 6 red flags, it is essential to contextualize Charlie Munger's expertise and why his insights remain indispensable in 2026. Charlie Munger was more than a billionaire investor. He was a lifelong scholar of human psychology, market cycles, and the recurring patterns of financial manias and crashes. Over nearly 99 years, he observed the repetition of a familiar cycle, ordinary investors chasing speculative trends, over-leveraging their positions, disregarding fundamental valuation principles, and suffering catastrophic losses when bubbles burst. Munger's core investment philosophy was defined by simplicity and discipline. Invest only in assets you understand, avoid speculative behavior, exercise caution when others exhibit greed, and never commit significant capital to a can't-miss trend. Notably, he navigated the 2000 dot-com bubble by maintaining a defensive posture, refusing to invest in overvalued technology stocks with no earnings, unproven business models, or no clear path to profitability. While the broader market chased paper gains, Munger exercised patience. When the bubble collapsed, he acquired high-quality companies at discounted valuations, compounding wealth over decades. Today, we are witnessing a near-perfect recurrence of the 2000 mania. Hype surrounding artificial intelligence has propelled tech stocks to valuations not seen since the dot-com era. Companies increasingly rebrand themselves with AI to secure funding, retail investors flock to AI-focused ETFs and speculative equities, and mainstream financial media promotes the narrative that AI will revolutionize every industry, rendering traditional valuation metrics obsolete. This echoes the rhetoric of 1999, when the Internet was hailed as a transformative force that would rewrite market rules. It is precisely this parallel that makes Munger's warnings critical today. He did not merely predict the dot-com crash, he established a framework for identifying speculative bubbles in any market environment. Today, we apply this framework to diagnose the current AI bubble and outline strategies for survival and long-term success. Then what are Charlie Munger's 6 deadly red flags of an economic meltdown? We now analyze each of Munger's 6 warning signs, clarify their implications, and assess their alignment with the current market landscape to determine the proximity of a potential crash. Red flag 1, irrational exuberance and speculative mania. Munger's first and most prominent red flag is a market driven by hype, optimism, and speculation rather than fundamental economic awe. Corporate performance. He famously noted, "If you've been in investing for 10 years and you haven't seen a bubble, you're not paying attention." Bubbles universally originate from a collective sentiment that everyone is accumulating wealth, and abstaining from participation is a sign of foolishness. In 2000, this manifested in day traders leaving their careers to speculate on .com stocks with no earnings. For example, Pets.com, an online pet food retailer that incurred losses on every sale, attained a market capitalization of $300 million at its peak. Investors prioritized ticker symbols and buzzwords over rigorous analysis of business models or profitability. Today, this dynamic is replicated in the AI sector. Companies such as Nvidia, with a price-to-earnings (P/E) ratio exceeding 100, trade at valuations surpassing those of many sovereign nations. AI startups with no revenue, no paying customers, and no viable path to profitability secure billions in venture capital funding. Retail investors allocate capital to AI ETFs, speculative meme stocks tied to AI, and short-term options trades, mirroring the behavior of .com-era day traders. Mainstream media amplifies the narrative that AI represents the greatest technological revolution in human history, asserting that every company will eventually become an AI company and that non-participation will result. Collective market becomes convinced that a new technology renders traditional valuation irrelevant, a crash is inevitable. Red flag 2, overvaluation and abandonment of traditional metrics. Munger's second red flag emerges when investors abandon focus on earnings, cash flow, and intrinsic value, instead prioritizing potential and future growth as justifications for investment. He emphasized, "Price is what you pay, value is what you get." When value is no longer a consideration, investing devolves into gambling. In 2000, the S&P 500 reached a P/E ratio exceeding 40, a level unprecedented before or since. Technology stocks boasted P/E ratios in the hundreds, or had no earnings at all. Investors resorted to alternative metrics such as price to sales and price to eyeballs because traditional earnings-based valuation was infeasible. Today, we observe an identical pattern. The Nasdaq 100 maintains a P/E ratio of over 35, approaching .com-era highs. Nvidia, the flagship of the AI boom, has a P/E ratio of over 100 and a price-to-sales ratio of 30. Companies like C3.ai, which has never generated a profit, boast a market capitalization exceeding $5 billion, solely due to its association with AI. Investors justify these extreme valuations with the same argument used in 2000, "This time is different." AI is a once-in-a-generation technology. This time is different. Every bubble is rationalized by a "this time is different" narrative, and every bubble concludes with a crash that restores valuations to sustainable levels. Red flag 3, excessive leverage and debt. Munger's third red flag is the widespread use of excessive leverage and debt for speculative purposes. He cautioned, "If you use leverage, you can get wiped out in a downturn, no matter how smart you are." Leverage amplifies gains during bull markets but exacerbates losses during bear markets, and it is the primary cause of catastrophic wealth loss for ordinary investors during crashes. In 2000, investors borrowed heavily on margin to purchase .com stocks. Margin debt reached record highs, and when the market crashed, investors were forced to sell their holdings at a loss to meet margin calls, creating a vicious cycle of selling that accelerated the market's decline. Today, margin debt remains near all-time highs, mirroring the 2000 environment. Retail investors leverage personal funds to trade AI stocks and options, while companies take on significant debt to fund AI initiatives, even in the absence of a clear path to profitability. Private equity firms utilize leverage to acquire AI startups at inflated valuations, creating a systemic risk that will materialize when market sentiment shifts. Munger warned that leverage is a silent wealth killer. Even if an investor correctly identifies the long-term potential, an entire leveraged portfolio. In bubble-driven crashes, corrections of 50% or more are common, making leverage an unacceptable risk for most investors. Red flag 4, the rise of get-rich-quick schemes and amateur speculators. Munger's fourth red flag is the proliferation of get-rich-quick schemes and the influx of inexperienced investors into speculative markets. He advised, the best way to get rich quick is to not try to get rich quick. When individuals with no investment experience, from service workers to retirees, begin speculating in the market, convinced of easy wealth, a crash is imminent. In 2000, this trend was evident in secretaries, teachers, and retirees leaving their jobs to day trade. Stocks. Many took out second mortgages on their homes to invest, believing that stock prices would only rise indefinitely. Today, this phenomenon has resurfaced. Retail investors use user-friendly platforms like Robinhood to trade AI stocks and options, often without understanding valuation, risk management, or market dynamics. Social media influencers on platforms such as TikTok and YouTube promote AI stock picks and speculative strategies, promising extraordinary returns with minimal effort. Individuals increasingly use personal loans and credit cards to fund investments, repeating the same mistakes of the dot-com era. Munger warned that the influx of amateur speculators signals the market's peak. Institutional investors, often referred to as smart money, sell overvalue assets to inexperienced investors at the bubble's height, leaving retail participants to suffer losses when the market collapses. Red flag 5. Overconfidence and hubris among investors and CEOs. Munger's fifth red flag is the emergence of overconfidence and hubris among investors and corporate leaders, who confuse bull market gains with inherent skill. He noted, never confuse a bull market with brains. When individuals and organizations believe they are immune to failure, they take on excessive risk, ignore warning signs, and ultimately suffer significant losses. In 2000, dot-com CEOs were celebrated as visionaries, gracing magazine covers and delivering keynote speeches at industry conferences. Investors who profited from the bubble attributed their success to genius, rather than favorable market conditions. Today, AI leaders, including Sam Altman and Jensen Huang, are elevated to celebrity status, with their public statements moving global markets. Investors who purchased AI stocks in 2023 and 2024 often credit their success to superior insight, overlooking the role of speculative hype in driving returns. Munger emphasized that hubris is the downfall of even the most sophisticated investors. When overconfidence replaces discipline, individuals abandon risk management, ignore valuation fundamentals, and expose themselves to catastrophic losses when the market corrects. Red flag 6, ignoring history and repeating the same mistakes. Munger's disregard for historical precedents, with market participants convinced that the past is irrelevant and this time is different. He famously quoted George Santayana, "Those who cannot remember the past are condemned to repeat it." Every speculative bubble is a repetition of the same mistakes, merely disguised by a new technological or market trend. In 2000, market participants argued that the Internet was a unique technology, rendering historical market cycles irrelevant. They ignored the lessons of the railroad bubble, the automobile bubble, the radio bubble, and every other speculative mania in history, only to suffer the consequences of their complacency. Today, the same argument is applied to AI. Proponents claim that AI's transformative potential makes historical market patterns obsolete, dismissing the dot-com bubble, the 2008 housing bubble, the crypto bubble, and other historical precedents. This refusal to learn from the past has led investors to repeat the exact mistakes that eroded wealth in 2000. Munger dedicated his career to studying market history because he understood that human nature, driven by greed and fear, does not change. The same psychological forces that fueled the South Sea bubble in 1720 drive today's AI mania. This is why his warnings remain as relevant in 2026 as they were 2 decades ago. How about the AI bubble? Is it the new dot-com crash? Having analyzed Munger's 6 red flags, we address the critical question: is the current AI bubble poised to replicate the 2000 dot-com crash? The answer is clear: in structure and dynamics, yes, if not in exact timing. A side-by-side comparison of the 2 bubbles reveals striking parallels. 2000 dot-com bubble, a transformative technology, the internet, with widespread hype, overvalued stocks with no earnings, speculative mania, excessive leverage, amateur participation, and at this time is different narrative. 2026 AI bubble, a transformative technology, artificial intelligence, with widespread hype, overvalued stocks with unsustainable valuations, speculative mania, excessive leverage, amateur participation, and at this time is different narrative. The only distinction lies in the underlying technology, the internet in 2000 versus AI today. However, the psychological drivers, market dynamics, and investor behavior are identical. It is critical to clarify that AI is not a speculative fiction. The internet was a genuine, transformative technology that reshaped global commerce, communication, and society. While the dot-com bubble was a period of speculative excess, the few companies that survived, including Amazon, Google, and Microsoft, went on to become the world's largest and most profitable enterprises. The same will hold true for AI. AI is a genuine, transformative technology that will reshape industries from healthcare to finance, manufacturing to education. However, the current AI bubble represents speculative excess surrounding this technology, with investors exorbitant premiums for companies with no viable path to profitability. Most AI startups will fail, but the few that deliver sustainable value will become industry leaders. For ordinary investors, the critical challenge is how to identify and invest in the long-term winners, without suffering catastrophic losses when the AI bubble bursts. This is precisely the question Munger's wisdom addresses. He did not speculate on the dot-com bubble, he waited for the crash, then acquired high-quality companies at discounted valuations. This disciplined approach is the foundation of our strategy for navigating the AI bubble. The most important part for us is how ordinary investors survive and thrive in the AI bubble era. We now turn to actionable strategies that ordinary investors can implement to protect their wealth, avoid the pitfalls of the AI bubble, and capitalize on the long-term growth potential of AI. Strategy 1. Reject speculation. Prioritize fundamentals. Munger's primary rule for surviving a bubble is to avoid speculative investments. Investors should refrain from purchasing AI stocks solely based on hype, avoid meme stocks and short-term options trading, and never use leverage to invest. Instead, focus on companies with strong fundamental metrics, consistent earnings, robust cash flow, a sustainable business model, and a reasonable valuation. For those seeking exposure to AI, prioritize established companies with proven AI revenue streams, consistent profitability, and a track record of innovation, such as Microsoft, Google, Amazon, and Nvidia, only at a sustainable valuation. Avoid unprofitable startups, speculative equities, and companies that merely rebrand themselves with AI to attract investment. Strategy 2. Reduce leverage and establish a cash buffer. Munger repeatedly warned of the dangers of leverage. Investors with margin debt should repay it immediately to eliminate the risk of margin calls during a market correction. Additionally, establish a cash buffer equivalent to 3 to 6 months of living expenses. This buffer ensures that investors can weather a market crash without being forced to sell assets at a loss. Cash becomes a strategic asset during market downturns, providing the flexibility to acquire high-quality companies at discounted valuations, exactly as Munger did following the 2000 dot-com crash. Strategy 3. Diversify your portfolio. Avoid overconcentration in the AI sector. Diversify your portfolio across multiple asset classes and sectors, including value stocks, dividend-paying equities, bonds, gold, real estate, and international markets. When the AI bubble bursts, non-tech sectors are likely to be more resilient, mitigating overall portfolio losses. Diversification is widely recognized as the only free lunch in investing, and it is the most effective way to protect wealth during market volatility. Strategy, than days or months. Attempting to time the market, predicting the exact moment the AI bubble will burst, is a futile exercise. The bubble could collapse in 6 months, 2 years, or long. However, investors who adhere to Munger's principles, rejecting speculation, prioritizing fundamentals, reducing leverage, diversifying portfolios, and adopting a long-term perspective, will not only survive the crash but will emerge with greater wealth and financial security. If you found this analysis valuable, please subscribe to Market Meridian for additional in-depth financial content. We welcome your thoughts in the comments section. Do you believe the AI bubble will crash? And what strategies are you implementing to protect your wealth? Thank you for joining us today. We look forward to providing further analysis in our next broadcast. Disclaimer: the content presented in this video is for educational and informational purposes only and does not constitute personalized financial advice. All investments involve inherent risk, including the potential loss of principal. Investors should consult with a qualified financial advisor before making any investment decisions. The opinions expressed herein are solely those of the host and do not reflect the views of any affiliated organization.